What's up, guys? Welcome to the channel. Today I'm going to share with you one of my most effective trading strategies, the ride on liquidity with a unicorn model for entry. If you have ever struggled with chasing price or understanding how price reacts from liquidity, stick around because I'll walk through each step, show you real world examples, and show you how you can incorporate this into your trading strategy. Without any further ado, let's get into it. A liquidity raid occurs when price aggressively moves to take out key levels where traders place their stop losses or their breakout orders. Why does this happen? Because large traders need liquidity to enter or exit their positions. These zones are where stop losses and pending orders are clustered, providing the liquidity required to fill their orders. Let me quickly show an example of what that would actually look like. All right, so let's just use our imaginations right here. So let's say price is moving down, right? And something happens. Some traders perhaps see a double bottom forming. Another trader might see some sort of bull flag. Now price starts to move up, right? Now you will have trader A that went long in this position based on something that he saw. He would enter the market, put his stop, let's say below this low, right? Now trader B would also enter his position, let's say based on some flag or something that he saw in price action. He would enter the market, put his stop loss below these lows, and trader C will also enter the market based on something that he saw in the market, right? SR flip or a breaker block or whatever it may be. So now there's a cluster or a accumulation of sell limits in this area, right? So a bunch of promises to sell. So now a larger player that wants to enter the market can target this area. So while a larger trader can put his buy orders, so it pairs up with all of the sell stop losses for everybody that went long. So a larger player can absorb all of these positions to basically enter the market. So that's why the larger players will attack these areas where stop losses are normally located. So why does the liquidity matter? So these levels are critical because they act as magnets for price. The highs represent buy side liquidity. Traders place their stop losses for their short positions above this level, and breakout buyers have pending buy orders here. The lows represent sell side liquidity. Traders place stop losses for their long positions below this level, and breakout sellers have pending sell orders here. Once price raids these levels, it often reverses, creating an opportunity for us to capitalize on the move. Go back to the chart. So whenever you have lows or relative equal lows, that is known as sell side liquidity. So if price comes into this area, everybody that went long will have to sell their positions to close, and the larger player or smart money can then absorb all of these stop losses. And then typically when the stop losses have been absorbed, price will move in the opposite direction. And that is what we are trying to capitalize on. Now the same for the buy side liquidity. Clean this up. Okay, so let's say the market has been trending up. Now something happens, the market reverses, right? So now you have a bunch of traders going short. Trader A is going short based on a double top. So he will go short, put a stop somewhere in that area. Another trader will enter the market short. He will put his stop also in the same area. The same with trader C, and you will get a large accumulation of buy stops in this area. Now what will happen a lot of the time is price will come up into the cluster of liquidity where the larger player will absorb all of the buy stops, and then price likes to reverse. So this is the area that the larger players will typically attack so they can enter the market or offload their positions. We're going to use a certain signature in price action to confirm that those stop losses have actually been absorbed, and that will be our trigger to enter the market. So the first thing that we need to understand for that signature in price action is breaker blocks and fair value gaps. So I'll quickly run through breaker blocks. I have a video on my YouTube channel that covers breaker blocks and fair value gaps in more detail. But a bullish breaker block is the highest up close candle or range of up close candles between the last two lower lows before the market structure shifts. So right here, you have a low, price comes down, takes out the low, then aggressively starts to move to the upside. This candle closes above the high, confirming this as your breaker block. So you can either wait for a retrace into the breaker block or simply just enter on the confirmation of the breaker block. A bearish breaker block is the lowest down close candle or range of down close candles between the last two higher highs before the bearish market structure shift. So here we have a high, price comes down a little bit, then it sweeps the buy side liquidity and starts to break down. This candle closes below that low, confirming this as your bearish breaker block. And you can wait for the retrace into the breaker block or just enter on the confirmation of the breaker block. So the next signature that we need to understand is a fair value gap. So this is a 3 candle formation, and the fair value gap is the open area between candle 1's high and candle 3's low. So it's that open area that is the imbalance called a fair value gap, also known as a busy. So a buy side imbalance, sell side inefficiency. And this is the SIBI. So this is also a 3 candle formation where the fair value gap is the open area between candle 1's high and candle 3's low. So that open area is the imbalance called a SIBI fair value gap, also known as a sell side imbalance, buy side inefficiency. All right, so we are going to combine those two signatures, and this is known as the unicorn model. A unicorn model is a high probability trading setup that combines two powerful concepts, the breaker block and a fair value gap. So we want to see that breaker block and the fair value gap overlapping. This displacement is an indication that the stops have been absorbed. Right, so the trading strategy, it's only got 5 items. It's very simple. It's identify the liquidity zones. So we look for the previous day's high or low or kill zone high or lows as likely rate targets. Also consider relative equal highs or lows. So we wait for price to trade into the liquidity zones, and I'll show you how to identify them on TradingView. Then wait for the raid. So monitor for an aggressive sweep of these liquidity levels. And then we want to see displacement. So after the raid, price must move away from the liquidity zone with momentum, creating the breaker block and fair value gap. This confirms a shift in order flow. Entry trigger. Wait for price to retrace into the breaker block or fair value gap. The 1 minute and the 2 minute is what we use to enter the trade. And then the stop loss and target. So stop loss will be below the breaker block. So right there for longs. And for shorts, it will be above the breaker block. And the target will be the opposing liquidity or an opposing PD array. But I'll show you how you can use your Fibonacci tool to identify decent targets. Right, so if we look at this price action, price came into the liquidity, then started to displace away, creating the breaker block. So the up close candle or range of up close candles before the move down that takes out the low. If price comes up and closes above the high, that will be confirmed as a breaker block. And here we also have the fair value gap, the displacement indicating the absorption of the stop losses. And they are overlapping. So this is a valid unicorn setup. So you can either enter the long position when price closes above the breaker, confirming the breaker block, or you can wait for a retrace into the breaker block and then target the opposing liquidity. Also added this one, so I just wanted to show you that sometimes the fair value gap will be above the breaker block, and that is also valid. You always target the highest one, so you can make sure that you get your order filled. So entry in the fair value gap with your stop loss below the breaker block. All right, so trade management. So valid trade setups must have a 2-to-1 risk to reward ratio on 2.5 standard deviations to an opposing liquidity pool or PD array. So take profit at 2.5 standard deviations and move your stop to break even. And take profit 2 will be at 4 standard deviations. So a PD array or a liquidity pool at 4 standard deviations of the breaker block manipulation leg. But once we get into the real world examples, I'll show you exactly how to pull that FIB to get your standard deviations on your chart. Right, and then there's another signature that I like to use for entry. It's called the balanced price range entry model. So this is overlapping opposing fair value gaps. So you can see you have a strong move into liquidity. That strong move creates a busy fair value gap. But then when price trades into the liquidity and a larger player absorbs all of these stops, you get a strong move down that creates a sub fair value gap that overlaps with the initial busy fair value gap. So that is known as a balanced price range. And you can take an entry on the retrace into the closest fair value gap and then targeting the opposing liquidity pool or PD array. Right, so let's get into some examples. Come to the chart. I want to identify the liquidity. So the major liquidity pools that I look at is the previous day's high or low or the previous week's high or low. And then I also look at the kill zone levels. So you can find this in my Discord. The link will be in the description. But the other liquidity pools that I focus on is the high and low of the kill zone sessions. So the Asia, the London, the New York morning session, the New York lunch, and the New York afternoon session. So you want to identify the highest high and the lowest low in each of these time periods. And that will be your buy side and sell side liquidity pools based on the kill zone levels. The first level that I normally identify is the previous day's low and the previous day's high. So you just go to the daily chart and snap a horizontal ray to the high and the low of the previous day's daily candle. I'm on the 1 minute time frame on the Nasdaq futures. So as you can see, price is traded into the sell side liquidity below the previous day's low. And this is how I like to track price action. So I keep track of the up close candles. You'll see we have these up close candles, then the move down that takes out the low. So if price action now comes up and closes above the high, that will be a breaker block. So for our trading model, we want to see the rate on liquidity. So we have that. And now we want to see that unicorn model start to print, which is the breaker block and the fair value gap overlapping. All right, so right there, this candle closed above the high, confirming that as your breaker block. And then you also have a fair value gap right there. So this is a valid unicorn model. So what I would have done is just market it in at this point, top below the low. And then what you can do is you get your Fibonacci tool and you pull it for a bullish breaker from the low to the high. So this is the standard deviation levels that I use. Make these just a little bit bigger. Okay, so from the low to the high, you can see that one standard deviation is right there, 2 is right there, and 2.5 is right there. So the first target that we are going to look at is liquidity pool at the 2.5 standard deviations. And you'll notice that we have these relative equal highs. So that is a pretty good first target. And then as per the trading strategy for standard deviations or a PD array or liquidity pool around 4 standard deviations, that will be the last target. So let's see how this continues to play out. All right, so right there it hit the 2.5 standard deviations. So that would have been about 150 points on the Nasdaq, and the ultimate target being the previous day's high. All right, and eventually it traded into the previous day's high. So that would have been a total from entry to the previous day's high, about 260 points on the Nasdaq. So if you would have entered with one single mini contract, that would have been almost, well, just over 5 grand for that entire move. All right, so that's been an example of the one of the major trading strategies that I use. Just one more thing that I'll show you guys. So this is the decision tree that I follow on a daily basis. So identify the liquidity levels. So that will be the previous day's high or low, or the kill zone liquidity levels. Rate on liquidity, yes or no. If it's no, do nothing. If it's yes, wait for a breaker block and a fair value gap. If that happened, yes, enter half of the position on the retrace to the breaker, or just mark it in on the confirmation of the breaker. Order fold, yes. Enter half of position on next FVG. So I try to scale into my positions, and then TP1 at 2.5 standard deviations of the breaker, and TP2 4 standard deviations of the breaker. And then if the order did not fill, wait for a PD array to form on the 15-minute time frame. If it didn't, do nothing. If it did, wait for a retrace into the 15-minute PD array. If it didn't, do nothing. If yes, then wait for a breaker block and a fair value gap to form on the 1 or the 2-minute time frame. If it didn't, do nothing. If yes, then enter half of the position on the breaker. If the order is filled, yes, enter the next position on the next fair value gap. And if it didn't get filled, then do nothing. Then we'll come back tomorrow for another opportunity. And then, like I mentioned previously in the video, this is the liquidity levels that I observed. So the previous month's high or low, previous week's high or low, previous day's high or low, then the kill zone levels, and then also the data news releases. So if there's news at, let's say, 10 o'clock and it makes a big move to the upside, big move to the downside, you want to be observing the high and the low of that move. And then B, levels or any other untouched highs or lows that falls outside of these levels. All right, so I hope you enjoyed this video. If you did, please remember to hit that like and subscribe, and I will see you guys in the next one.